Jai Hind everyone. Welcome to my YouTube channel, which is Explore Yourselves, Banking and General Knowledge, etc. Today I will discuss some potential overseas posting examination questions and their corresponding sample answers for bankers. Today marks part 5 of my Path to the Corner Office series for overseas posting examination questions and their corresponding sample answers for bankers. Now MCQs from pre-shipment and post-shipment finance. ECGC's product ECIBPC protects option A exporters against buyer default, B banks against losses arising from exporters' failure to repay packing credit, C importers against non-delivery of goods, D banks against political risk in the exporter's country. The answer is option B banks against losses arising from exporters' failure to repay packing credit. The next question is, which ECGC policy is designed specifically for exporters whose annual export turnover does not exceed rupees 5 crore? A. Standard policy, GR policy, B. Specific shipment policy, C. Small exporter policy, D. Buyer exposure policy. The answer is option C. Small exporter policy. The next question is, political risk in the context of ECGC coverage includes A. Buyer's insolvency or bankruptcy, B. Buyer's refusal to accept goods without reason, C. War, government actions or foreign exchange moratorium in the buyer's country, D. Price fluctuation causing the buyer to default. The answer is option C. War, government actions or foreign exchange moratorium in the buyer's country. The next question is, under ECGC policies, commercial risk losses are typically covered up to A 100% of the loss, B 90 to 95% of the loss, C 75 to 85% of the loss, D 50% of the loss. The answer is option C 75 to 85% of the loss. The next question is, ECGC's standard policy is also called option A GR policy, option B PSC policy, option C ECIBWT, option D whole turnover policy. The answer is option A GR policy. The next question is, EXIM Bank of India was established in which year? Option A 1969, option B 1975, option C 1982, option D 1991. The answer is option C 1982. The next question is, lines of credit extended by EXIM Bank of India refers to option A credit extended to Indian importers for buying foreign machinery, option B credit extended to foreign governments, banks or financial institutions to purchase Indian goods and services, C credit limits sanctioned to Indian commercial banks for export refinancing, D credit given to EOU units for setting up manufacturing. The answer is option B credit extended to foreign governments, banks or financial institutions to purchase Indian goods and services. The next question is, NEIA National Export Insurance Account is managed by ECGC works with EXIM Bank for option A short-term consumer goods and goods export, option B project exports to difficult and high-risk markets where commercial insurance is unavailable, C MSME export credit guarantee only, D ensuring FCNR deposits used for PCFC. The answer is option B project exports to difficult and high risk markets where commercial insurance is unavailable. The next question is, forfeiting is different from export bill discounting primarily because A. Forfeiting is available only for rupee denominated bills. B. Forfeiting is done without recourse to the exporter. Discounting is with recourse. C. Forfeiting is a government scheme. Discounting is by banks. D. Forfeiting involves only LC backed bills. Discounting only non LC bills. The answer is option B. Forfeiting is done without recourse to the exporter. Discounting is with recourse. The next question is, in forfeiting, the term able refers to option A, the forfeiter's margin on the transaction, B, a guarantee or endorsement given by the importer's bank on the promissory note or bill, C, the advance payment made before shipment, D, the collection instruction given by the exporter's bank. The answer is option B, a guarantee or endorsement given by the importer's bank on the promissory note or bill. The next question is, forfeiting is typically used for A, short-term consumer goods export 30 to 90 days, B, perishable agricultural exports, C, medium-term capital goods export 1 to 7 years, D, deemed export supplies to EOU units. The answer is option C, medium-term capital goods export 1 to 7 years. The next question is, in export factoring, a non-recourse arrangement means option A, the exporter must return the advance if the buyer doesn't pay. B, the factor bears the credit risk. The exporter is not liable if the buyer defaults. C, the factor collects from both buyer and exporter. D, the importer's country government guarantees payment. The answer is option B, the factor bears the credit risk. The exporter is not liable if the buyer defaults. Next question is, international factoring typically involves how many factors? A, one factor in exporter's country only. B, two factors, an exporter factor and an import factor in buyer's country. C, three factors including ECGC. D, one factor appointed by the ICC. The answer is option B, two factors, an import factor and an export factor in buyer's country. Next question is, which of the following is not a category of deemed exports as notified by DGFT? A, supply to export-oriented units, EOU. B, supply to SEC units. C, supply of goods to Indian retail consumers in duty-free shops. D, supply to projects funded by World Bank or ADB. The answer is option C, supply of goods to Indian retail customers in duty-free shops. The next question is, a two-star export house status is granted to exporters with an export performance FOB value over the preceding 3 years of at least A, rupees 3 crores, B, rupees 25 crores, C, rupees 100 crore, D, rupees 500 crores. The answer is option B, rupees 25 crores. Thank you very much for your patience. Please like and share this video and subscribe to my YouTube channel.